Hello, this is Sam Kramer. I'm a partner in the IT and Communications Practice Group at Baker & McKenzie in Chicago. And today I'll be talking to you about the operation of the Bitcoin blockchain. We'll talk a little bit about how an idealized version of the Bitcoin blockchain works so that you can get an understanding of the mechanisms of this distributed ledger technology, and especially its consensus protocols and why they're so important. In 2008, a shadowy figure going by the pseudonym Satoshi Nakamoto published a paper describing peer-to-peer cashless digital currency and transmission system, requiring no central authority to issue currency or to validate exchanges of that currency. The currency and the medium has since led to a revolution in peer-to-peer transactions, and Bitcoin was born. Since Nakamoto's paper, blockchain technology, and the Bitcoin digital currency specifically, has become something of a cultural phenomenon, described alternatively as transformational, disruptive. Nobel economist Paul Krugman even referred to it as evil. This technology has not lacked for hype. The price of bitcoins has fluctuated wildly since Nakamoto began mining, and the spectacular bankruptcy of the Mt. Gox exchange has kept Bitcoin in the news. Today I will be explaining, as best I can, the underlying function of the transactional system underlying Bitcoin called the blockchain. It's a distributed ledger technology that uses the power of the peer-to-peer network to validate transactions and maintain an immutable record of all transactions agreed to by the network. While blockchain technology has applications beyond virtual currency to all manner of transactions, including land transfers, stock transfers, and smart contracts, among others, I'll focus on an idealized version of Bitcoin because it is the most mature and distributed blockchain. It's worth pointing out that banks experimenting with blockchains are not using the Bitcoin blockchain. There are a number of reasons for this, principally that the applications that banks are considering, for example interbank transfers, presume trusted parties will validate transactions, obviating the need to replace trust with proof of work. What are the desired properties of a non-intermediated transfer system for the exchange of value? Transactions on the network need to be secure. The network must be decentralized so that its control is not concentrated. And it should not require trusted third parties to validate transactions. Distributed ledger technology, such as blockchain, achieves each of these. Security is provided by the cryptographic functions. The system is decentralized, using a peer-to-peer network with low barriers to participation. And there's no trusted third party required, using distributed consensus to foster communal agreement on validated transactions. In the digital world, transactions, or more specifically the record of transactions, needs to be broadcast widely, yet its contents needs to remain both private and secure. Cryptography is well suited to enable these features on the digital platform. In particular, for reasons that I'll point out throughout this presentation, the algorithm or cipher we use should have the following properties to support the desired characteristics of the network. First, it should be collision-free, meaning that for any two different inputs x and y, our cipher must generate a different output value. Second, it must be hiding, meaning that from the output of the cipher, called the hash, it is infeasible to determine the input. And third, it must be puzzle-friendly. Where the cipher is used to create a cryptographic puzzle, there should be no strategy that is more likely to generate a correct solution than any other, meaning that solutions will be obtained through random guesses. These qualities of the cipher used in the blockchain will not prevent a malicious actor from fraudulent activity, such as altering transaction logs to manipulate transactions. However, it will produce a tamper-evident log that the network will refuse to make part of the long-term consensus chain of transactions. We will walk through this idealized variant on the Bitcoin blockchain protocol to get an understanding of how transactions are recorded, assembled, validated, and verified. One of the features of applying cryptographic ciphers to information is that inputs of various sizes, when hashed, produced an output of a fixed size. Because of the collision-free property, the output of each input is different, such that if you change one small part of the input, or message, or transaction, such as adding a space or deleting a decimal point, you get a completely different output that's hard to predict. And because of the hidden property of the blockchain, it's infeasible to derive the input from the output. We'll get to what puzzle-friendly implies later when we talk about the concept of proof of work. In Bitcoin, the algorithm that's used is called double SHA-256, which, when applied to an input, generates an output in fixed chunks of 512 bits, together with a user-defined number of zeros to get the full chunks of 512 bits each of which we run through a compression function. The output string of the hash is a fixed 256-bit output. This cipher is used in Bitcoin to hash each transaction, as well as hashing each block proposed for addition to the blockchain. Consider the simple transaction where A wants to transfer value, such as a Bitcoin, to B. The digital currency in Bitcoin is not a representative token. Rather, it's a transaction record of the transfer of Bitcoins previously received by the party that wants to onward transfer them. The data structure of a Bitcoin transaction looks like the following. It contains a digital signature of the sender A, that is A's address, that has been encrypted using ECDSA, elliptical curve digital signature encryption. It contains the public key of B, the recipient, which is B's address. It contains a hash pointer, which points to the prior transaction in which A received the Bitcoins to be transferred to B, and it contains an instruction of transfer. Transfer X number of Bitcoins from A to B. This has the peculiar feature of making a transfer of Bitcoins a packing problem, trying to assemble prior transactions of received Bitcoins to match the Bitcoins to be transferred. Since this rarely adds up nicely, Bitcoin transactions are usually made up of some transfer of Bitcoins to the recipient with another transaction to send the change back to the sender. Once this transaction is hashed, it is broadcast to all listening nodes on the network. All nodes have copies of the full blockchain, a tamper-proof transaction log that goes back to the first block of transactions called the Genesis block. Anyone downloading a Bitcoin wallet can be a node on the network. All nodes have a copy of the blockchain. Each of the nodes maintains a record of all previous transactions that have achieved long-term consensus. The distribution of identical copies of the ledger to all nodes makes hacking the blockchain inordinately difficult. There is no single repository to attack. Nodes that hear of transactions on the network can easily verify whether the transaction proposed is available to the sender. Because the transaction contains a hash pointer to the previous transaction in which the sender received the Bitcoin, and every node has a copy of the blockchain, the node can determine if the hash pointer points to a previous transaction that was not subsequently spent by verifying that no other validated transaction on the blockchain points to that same prior transaction. If the transaction was not previously spent, then the node will rebroadcast the transaction to the network for miners to mine. If the transaction was previously spent, the transaction will be ignored by the network. Some of the network members will attempt to confirm the transaction in a process known as mining. Miners, which are merely nodes on the network that choose to engage in this process, will assemble transactions they've heard about into a block. Miners will propose new blocks to add to the blockchain maintained by all the nodes on the network. Each block mined by a miner has a block header composed of the following: the protocol version of the blockchain software, a hash pointer that points to the previous block, a Merkle root, which is a hash of pairs of all transactions in the block to arrive at a single hash of all hashes, a moderately accurate timestamp because of network latency and other reasons, and the mining difficulty value expressed in bits. This information is appended to the group of transaction that comprises the block, and the total block size limit at the moment is 1 megabyte. We've heard recently of a fork in the Bitcoin blockchain to create Bitcoin Cash, in part because of a split over the maximum size of blocks. Miners take the assembled transactions and block header, and by hashing that block, that is, using the double SHA-256 algorithm, they attempt to solve a computationally difficult problem. They must generate a fixed length output, a hash, that is within the target range set by the software. To do this, a miner chooses a nonce, which is a random number used for computing the hash of the block. And if he is really lucky, the output of hashing the block with that nonce will produce an output within the target range. This is the hash puzzle the miner must solve by repeatedly hashing or mining. With every unsuccessful hash attempt, the nonce is changed. And if no nonce is produced an output within the target range, other aspects of the block are changed. Transactions are added, which would change the Merkle root, but the timestamp may be modified, and the hashing continues. The target range represents the difficulty of the computational puzzle, and in Bitcoin, it's parameterizable. Remember the mining difficulty value in the block header we identified before? The Bitcoin software adjusts the level of difficulty every 2 weeks so that, given the global network hashing power, the average time to solve a block always remains approximately 10 minutes. And since our cipher is puzzle-friendly, this rehashing over and over again is all trial and error. Remember, there's no strategy to solve this puzzle that is any more likely to produce a solution than any other. How hard is it to mine a block in Bitcoin? It takes an insanely huge amount of computational effort to mine a block, but it's easy for peers, nodes, on the network to verify that a block has been successfully mined. An ordinary PC might produce 42,000 hashes per second. At that rate, it would take one such PC, running continuously, about 35,000 years to mine a block. Since with current global computational power, a block is solved once every 10 minutes on average, and with the current computational difficulty and introduction of application-specific integrated circuit, ASIC, computing, as of January of last year, we can estimate that 1 quintillion, that's 1 with 18 zeros, 1 quintillion blocks are hashed every second. The global hardware costs run in the tens of millions of dollars, and the collective energy consumption for mining blocks rivals that of the country of Cambodia. Once every 10 minutes on average, a miner will solve the hash puzzle and generate an output that is within the target range established by the mining difficulty value, and will propose that block to the network for acceptance. Miners race each other to solve the hash puzzle. When a solved block is proposed, and the other nodes on the network verify that it has been solved by hashing the block header with the winning nonce, it is easy to verify or check the miner's work. Miners will then quickly abandon their work that contained any transactions validated in proposed blocks and go back to assembling a block with any unvalidated transactions, and then race to solve the hash puzzle and propose the next new block. We know that all valid transactions will eventually get put into a block that gets mined and proposed to be added to the blockchain. In our example here, it's the miner at node 2 that has solved the hash puzzle and proposed its block. Since the proposed block has a hash pointer, it indicates which block in the chain the proposed block is going to build on. How do we know if the proposed block from node 2 has been accepted? Well, in our race, each of node 1, node 2, and node 3 were hashing blocks that had a hash pointer to the last block on the blockchain. When a solved block is proposed, the other miners abandon their prior work and begin assembling transactions anew. When they do that, they need to recalculate the hash pointer to point to the previous block. Miners all observe the convention to build on the longest part of the blockchain, and that's because the deeper your block goes into the blockchain, the more likely it is to remain in the accepted transaction log and become part of the long-term consensus. Each time a node builds upon a subsequent block in the blockchain, we call it a confirmation of our proposed block. If two blocks are solved at roughly the same time, there is a potential fork in the blockchain. This forking is fairly common. It happens about once a day on average. We see which blocks the remainder of the network chooses to build upon. The fork that is not built upon is abandoned and referred to as an orphan block. Transactions that have not made it into the blockchain are still in the queue of outstanding transaction for all nodes on the network and are assembled into the next block that is mined. By building on the longest part of the chain, we not only validate prior blocks, but we reduce the likelihood of a double spend attack, two nearly simultaneous but conflicting transactions, because it gets significantly more unlikely that the forked side of the blockchain will catch up in length to the other fork of the blockchain. Where other nodes on the network confirm the proposed blocks because the miner has demonstrated its proof of work, that is, has solved the math puzzle, they signal that acceptance by building on that block. When nodes continue the race by mining the next block with a hash pointer to the last block in the blockchain, that subsequent block confirms the previously proposed block, and the alternative block on the other fork is abandoned, with its unconfirmed transactions available to all nodes on the network for inclusion in a future proposed block. Once there are 6 confirmations, that is, 6 new blocks on the blockchain after our proposed block, it becomes highly improbable that our proposed block will ever be abandoned and not become part of the long-term consensus of transactions on the blockchain. Therefore, after roughly 1 hour on average, the other side of our transaction, our recipient B, may consummate the contract, secure in the knowledge that it is highly unlikely that the transaction will be unwound. This confirmation process neatly demonstrates the tamper-evident nature of the blockchain and how distributed consensus can defeat a double spending attack. Suppose our 2 proposed blocks contained incompatible transactions, ones where sender A transfers the same bitcoins to recipient B and recipient C. From the network perspective, each of those proposed transactions are equally valid because we can't rely precisely on exact timestamps, and the nodes will choose to build on one, which is why a recipient waits for 6 confirmations to see which fork becomes part of the long-term consensus and whether it contains the transaction where he is to receive the bitcoins from party A. If A is a malicious actor and is trying to spend bitcoin she previously spent in a transaction recorded earlier on the blockchain, she would have to tamper with the transactions, in our example above in T6, to make it appear that the transaction is to recipient C, not recipient B. But in so doing, she changes the hash pointer of the block containing the altered T6 because the hash pointer includes the hash of the Merkle root, or hash of all hashes, that included the unaltered T6. So then she would have to change the hash pointer of the block in which she received the bitcoin she is trying to transfer, transaction T4, so that the hash pointer from the prior block squares with the block containing the altered transaction. But in so doing, she changes the hash pointer of the block containing the altered T4, and so on, all the way back to the first block in the chain. We saw earlier that the mining process is computationally difficult, requiring significant outlays for network computing power. The expense of the proof-of-work aspect of the Bitcoin blockchain has certain network benefits. First, because the likelihood of proposing the next block varies in proportion to the network computing power controlled, proof-of-work takes the place of a random choice of the node that will propose the next block, because it would require controlling 51% or more of the total network computing power to cause its mined blocks to be confirmed on the blockchain. Second, the cost of mining keeps the network from being flooded with proposed blocks by excessive mining activity and driving down the average time solved between blocks. Third, the cost of Bitcoin mining acts as a tax on identity creation. Because there is a cost to the mining activity, it becomes too expensive to flood the network with multiple identities and attempt to project consensus on the network, a process known as a Sybil attack. It makes sense now to ask the question, why would anyone engage in this expensive, essentially useless activity to validate transactions for strangers? This is the incentive engineering portion of the Bitcoin blockchain. For each block successfully mined, the miner receives newly minted bitcoins, known as the block reward. That reward currently stands at 12.5 bitcoins per block solved, which amount is halved every 4 years. At current estimates, by May 2140, the last new bitcoin will be produced, reaching a total bitcoin supply of 21 million bitcoins. For the future of Bitcoin and other transactions using this blockchain and proof of work to validate transactions, transaction fees, an instruction that transfers some value to the successful miner, will become a mandatory feature. We have now walked through an example of distributed ledger technology that uses distributed consensus among a large group of network participants to agree upon the sequence of transactions validated through proof of work. Blockchain technology can be applied to different types of networks. There are private blockchains that require a central authority to grant membership that have a low incidence of malicious behavior because that central authority vets members. There are hybrid blockchains or permission blockchains that still rely on some centralized credentialing authority such as registration. And then there are public blockchains, such as the Bitcoin blockchains, that are fully decentralized, other than perhaps the small community of developers of the software protocol. Most of our discussion today has been around the Bitcoin cryptocurrency transfer with the Bitcoin blockchain, but there are many other applications to transfer records. Digital currencies, land transfers, private shares, diamonds, and smart contracts. We've seen any number of new initial coin offerings this year, and blockchain technologies are experiencing a gold rush. Thank you for watching and listening to this presentation on the Bitcoin blockchain and the importance of distributed ledger technology and its consensus protocol. I'd be happy to respond to questions or comments that you may have at the email address on this slide.